Welcome to the win-win option strategy. If you ask a group of stock and option investor what were their first option play, chances are high most of them will say it was a cover call option strategy. The reason for that is the benefit of the cover call option strategy. Let's take a look. Reduce the losses on the shares if the stock went down, create income stream while holding the shares, simple to understand and execute, and can be used to exit a stock at a certain price. As for the disadvantage, there's only one, which is limited upside potential. Let me take you through the steps to break it down for you and you will understand everything. There's only one requirement to sell a cover call. You have to own 100 shares of the underlying stock. So let's take a look at this chart. In this example, we are assuming that you bought 100 shares of a stock that are priced at $100 right now, and you sell a cover call at 105, meaning you are willing to sell the stock for 105 by a certain date. If the stock rises to 105 or above, you have an obligation to sell it for 105. If the stock expired under 105, then the option expired worthless. In either case, you get to keep the premium that you receive upfront for selling that cover call. In this example, the premium is $5, meaning $500 per option. The $5 premium that you receive upfront will reduce your average per share from $100 to $95, making the 95 is the new break-even number for you. I should also explain the graph. The vertical line represents your profit or loss, while the horizontal line represents the underlying price at expiration. The max profit is reached at 1,000 when the stock expires at 105 or higher. And the 1,000 consisting of 500 the premium that was received for selling that cover call and 500 from the gain of the stock. When you purchase the stock at $100, there is only three directions that the stock price can take. The first is going up, the second is staying or trading within the same range, the third one is the stock take a dive and go down. Let's take a look how the cover call option strategy will behave in each of these three scenarios. The first one, if the stock goes up and it went above our strike price, the 105. In this case, we will achieve our maximum profit from this trade. The option will get assigned and we will have to sell the stock for $105 per share, even if the stock was at 110, 120. In this case, we didn't really lose, we still made a profit of 1,000. We just lost on a potential additional winning. So even if the price of the underlying stock went above our strike price, which is 105 in this example, there is a way around it if you are not willing to sell the stock. If the price was at 110, 115, 120, we will probably be able to roll it over to a further date. They call it rolling up and out. In the second scenario, the stock will trade within the same range, going up and down, but expiring at or near the price that we paid for it, which is $100. In this case, the option will expire worthless and we will get to keep the stock and of course keep the premium that we made. And we will be able to sell a new cover call if we chose to with the same strike, different date, or even going higher if we became more bullish on the stock. In the third option, the stock will go down. So let's say the underlying stock went down from $100 to $90. Similar to the second scenario, the cover call option will expire worthless. The $5 premium that we receive per share at the start will help us reduce our losses since the stock is at $90 instead of $100. Let me take you through a step-by-step on how to sell a cover call on Apple. First, we go to the trade Apple option. We make sure we have the call selected and we choose the sell. After that, we go to choose the date. You can sell it for weekly. It's basically every Friday, unless Friday is a holiday. You can also sell monthly, quarterly, or yearly. I always prefer to sell about 2 to 3 months out. Depends on what's going on with the stock. that will give me enough premium to make up for any move to the upside or downside. So in this example, let's go ahead and go to something like October. That's going to be 3 months. If we want to go ahead and sell a cover call for 200, as you can see, the buyers are willing to pay 292 while the seller are asking for 298. So you will have to meet them in the middle and hope that the option gets sold. In the future videos, I'll make a video discussing the Greeks in details. Robinhood generate a graph for the expected profit or loss. On the right side, you can take a look. Currently here at the current price, which is 187.53, you can see you are collecting your max profit for it, which is 295. And as long as the stock stay at 200 on the expiration date, then this contract will expire worthless and you get to keep the 295 plus the stock. You can see here that it shows the stock need to go up 6.6, it just changed, 6.6% to reach the 200. So anything above that, it will start reducing, missing out on additional profit that you were able to keep if you haven't sold the covered call. As I mentioned before, in this scenario where the stock price go above your strike, but it's not crazy up, it's just a little bit up, you can easily roll over the option. The implied volatility will determine how much the stock are expected to move, and that will directly affect the premium. Higher implied volatility will generate higher premium. So let's take a quick look at an example like Tesla. Although Tesla stocks are lower priced than Apple, because of the implied volatility being 49 compared to the 20 point something that we saw at Apple, as you can see, the premium are much higher than what we get from Apple, and that's with a bigger break-even range. In Apple, we only had to go up 6 point something before we get break-even, and in this case, the stock has to go up 25% to break even, which is, if you do the number for Tesla, the current price for Tesla is 175 minus the credit that we can receive, which let's say is $20. That's gonna be 155. We take the 20 divided on the 155, multiply by 100, it will show you the total return, which is in this case is 12.90 in 8 months. Divide that on the 8 month that we have to wait, it's gonna result in 1.61 of guaranteed return on Tesla. It can only get bigger if the stock went above 200. Then we will make money 2 times. One from the premium that we receive, and the second is from selling the stock at a higher price. I absolutely love trading Tesla options since it has a high implied volatility that allow you to roll the stock, up and out in case you didn't want to sell the stock. Same thing apply if we went to the 3 month. You will see it's much higher premium compared to Apple. So if we go something like this to the 200 and we want to sell, it's 800.45. Compare that to the premium we get from Apple stock, which is 2.95 for the same period. Now the reason for that is, as we mentioned before, is the implied volatility. Now keep in mind, when the implied volatility is high, that means the stock can move in either direction in a big move. So when we see here it's 50%, it could easily go down hard instead of up hard. And that basically why you get paid these big premium for holding the shares. Cover call can also be used to generate additional income on stocks that you are not expecting a big move to the upside. For example, here I can show you the Kraft stock, the KHC. My average is 39.88. Actually, in reality, my average is lower than that because I have collected credit from puts before it get assigned. If we scroll down, you will see my position in the stock. I have 1,023 share. My market value right now is 36,500. And I'm currently down on the stock 10%. Here you can see my cover call. I have sold 10 cover call for the price of 40 to offset my losses. And as you can see, I have collected 1,600, reducing my losses from 4,300 minus the 1,600 to 2,700. So 2,700 is so much better than losing 4,300. This stock is also a dividend stock. It generates 4.4 dividend yield that I receive on a quarterly basis on top of the premium I get from the cover call. These two generate a decent return for a stock that have been trading nowhere within the last year. As you can see here, it went down hard, it went up, it went down, up. I have also explained in this video how I was able to generate $15,649 from owning Apple, Microsoft for a little bit over a year. If you find this video useful, please consider subscribing, giving a thumbs up. I would also like to hear about your experience in the comment section below. I will respond to all comments. As always, the information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, including the potential loss of the principal. Thank you guys, and see you in the next video.